post just arrived. And if you're a UK retiree, this single envelope is guaranteed to generate more panic than any interest rate rise or triple lock debate. Why? Because this is the HMRC Tax Letter. And I'll bet you anything your neighbour is already calling you, breathless, asking the same terrified question. Did the government just silently change the rules and make our state pension taxable? Did the triple lock come with a secret nasty hidden clause? Is our state pension now officially under attack by the tax man? I got the letter too, and my first reaction wasn't dread, it was curiosity, because that's how we, the modern informed retirees, stay ahead of the game. Curiosity doesn't just keep your mind young, it keeps your wallet safe. Instead of accepting the panic, we get the facts. Today, we are diving deep into the HMRC's 2025 playbook. I'm going to bust the myth that's causing this entire panic. Then, I'm giving you a 4-point checklist to follow the moment you receive this letter to make sure you pay £0 more than you absolutely have to. Let's separate the headline fear from the financial reality. So let's start with the fundamental myth that 80% of people get wrong. The state pension is a guaranteed government benefit, so it must be tax-free. Myth busted. The truth is, and always has been, that your state pension is 100% taxable income. It's treated just like a private pension or a salary. So the panic isn't about a new rule, it's about a new catastrophic squeeze that has become the single biggest financial threat to retirees in 2025. I call it the Tax Drag Tsunami. Here is the simple, ugly maths. Thanks to the triple lock, our state pension is rising every year. Fantastic. But the government has kept your personal allowance, that's the amount of income that you can earn tax-free, frozen. So your personal allowance is frozen at $12,570 until 2028. Look at this chart. The gap is closing fast. In 2025, the full new state pension is around $12,040. If you get the full amount, that single payment is eating up nearly 96% of your entire tax-free personal allowance of the £12,570. That means almost every single pound you get from a private workplace pension, a small income from investments, or even interest from a savings account is now being pushed into the 20% tax bracket immediately. The HMRC letter isn't making your pension taxable, it's simply informing you that the combination of your incomes has finally exceeded that frozen threshold, and they're coming for their cut. So we now understand the problem. The solution isn't to panic, it's to prepare. The HMRC letter is a warning, and if you follow these 4 steps, you can minimise the damage and potentially delay paying tax for years. This is your tax fighting checklist. Step number 1, check your tax code. This is the most common mistake retirees make. The HMRC often assumes all your income is coming from one source, When they send you your new tax code, your P2 notice that is, they might mistakenly allocate the entire £12,570 personal allowance to your private pension provider. And if they do that, your state pension income will look like pure profit to them, and they will hit you with an enormous underpayment bill for the previous year. So, the action to take: you must check where your tax code is allocated. If you see the full 1257L code, that's 1257L code on your private pension statement, you need to call HMRC and ask them to split the allowance or transfer the code so that your state pension income is correctly accounted for. Do not let them auto-allocate it. Okay. Now, step 2 is the savings account trap. You've been so focused on your pension that you forgot about your cash savings. Remember the personal savings allowance? £1,000 of interest for basic taxpayers is tax-free. But with the state pension using up nearly all of your £12,570 allowance, that savings allowance becomes your only tax-free shield for interest. And if your savings income pushes you just £1 over the £12,570 threshold, you suddenly become a taxpayer, and your savings interest is now open season. So the action that you must take, if you have cash savings that generate anything over the £1,000 interest allowance, you must immediately access moving that money into a cash ISA. The interest inside an ISA is protected from HMRC entirely, regardless of your total income, and you can save up to £20,000. That's right. So come on. It's an easy move that closes the door on that tax drag. Step 3, declare all income. Now, the HMRC is getting better and better at cross-referencing data. If you have any small undeclared income, say a tiny rental income, a few dividend payments, or even the odd bit of part-time work, and you have not declared it to HMRC, they will find it. With your personal allowance so low, that tiny bit of undeclared income will be the spark that ignites a full-scale HMRC investigation. So the action you must take, well, be meticulous. If you've been lax with your tax reporting in the past, now is the time to correct it. The tax drag means they are looking for reasons to pull you into the tax net. Don't give them an easy win. Full transparency is your best defence. And here is the 4th step to include in your checklist regarding the HMRC Tax Letter and this 2025 tax drag. The 4th action is less about reacting to the current letter and more about mitigating future HMRC surprises by verifying your state pension eligibility. So why is this critical? The HMRC letter is a tax notification, but the size of your state pension, which drives the tax drag, is based entirely on your national insurance record. If you have gaps in your NI contributions, the HMRC might eventually calculate your pension at a lower rate than you expect, leading to a financial shortfall in retirement. Conversely, if you have gaps you can afford to fill, doing so now will maximise your tax-free allowance later. The modern retiree doesn't wait for HMRC or the DWP to tell them they have an issue. They find it first. So what are the action steps to take now? Well, check your record online. Go to the official gov.uk website and check your NI contribution history. Look for any gaps in the years you've worked. Get a state pension forecast. Obtain a full forecast to see exactly what you are projected to receive and when. This solid number is what you should use to calculate your future tax burden. And 3, consider voluntary contributions. If you have affordable gaps in recent years, usually the last 6 years, consider making a voluntary Class 3 NI contribution. While the cost of contributions is rising, the increase you get in your state pension, which is paid for life and is largely tax-free if you have no other income, can be one of the best returns on investment that a retiree can make. So by maximising your state pension now, you stabilise the single biggest income factor driving your future tax liability, giving you control and knowledge, the 2 best ways to stay ahead of the HMRC game. Let's recap, shall we? So here is the final verdict. This HMRC tax letter that we'll receive in 2025 is not a conspiracy, but it is a wake-up call. The myth is that the rules changed. The truth is that the tax drag is working exactly as the government planned it to, pulling millions of new pensioners into the tax net. And the tax drag is because of the tax allowance, which is £12,570 and set to stay there until 2028. We're the modern retiree, aren't we? We refuse to be the generation that panics. The curious, informed retiree turns fear into focus. We now know the 4 critical steps to take the moment that letter arrives. We will not let this government tax drag erode the retirement we worked for. If this script saved you even 1 minute of worry, hit that like button and the subscribe button, please. If you want to keep busting these myths with me and keep your financial security sharp, then yes, please subscribe. Here's a final thought. The HMRC will keep sending the letters and the newspapers will keep creating the fear, but we'll stay smart, stay knowledgeable, and remember, curiosity doesn't just keep you young. Oh no, it keeps you financially free. Until next time, stay ahead of the game, won't you? Bye from Angie.